Hi friends, today we will talk about the following topics. What is external commercial borrowing is, the form of ECB and the benefits under ECB. So let's begin. External commercial borrowing is basically the type of borrowing. Here borrowing means a loan. So it is the type of loan which is availed by a eligible resident entity, or we can say that it is raised by a eligible resident entity from a non-resident entity. Now who is this eligible resident entity is? It is none other than a Indian entity which is raising such loan, whereas a non-resident entity is a foreign entity, or we can say a foreign lender which is providing such loan facility, right? So if I want to say in a simple way or in a easier way, then I can say that external commercial borrowing is basically that commercial loan wherein the Indian entity is borrowing funds from outside the territory of its country, right? From a foreign lender. That is called as external commercial borrowing. Now move forward. Now we will talk about the advantages of ECB. Let's begin with large volume of funds. So it is one of the advantages of ECB. Here a borrower means a Indian entity is availing or raising large volume of fund, and the max cap limit of this availing such large volume of fund is max $750 million, which is quite being large if we compare it with other source of financing. So a borrower can avail large volume of fund under ECB. Let's move on to another one. It is lower ROI. Here ROI stands for rate of interest, or we can say that it's a cost, right? So here borrower is not only raising large volume of fund but also availing such loan facility at a cheaper rate if we compare it with other source of financing, or we compare it with other domestic financing, right? And the last one is the longer maturity period. Here maturity periods denotes the time frame for making the loan payment. In simple, I can say that it is the tenor of payment, tenor of loan, sorry. Right? So under ECB, one can get a longer tenor, means the tenor starts from 3 to 10 years. It can be a 3 year tenor, it can be a 5 year tenor, it can be a max 10-year tenor. So it depends the type of industry availing ECB and the purpose for which it is availing. So the tenor depends basically on the two things. Now let's move forward. Now we will talk about the forms of ECB. Means the ECB can be arranged in these 5 forms. Now what are these? First is in the bank loan. As we all know that it can be in the form of a bank loan which is provided by a foreign bank or by a foreign financial institution, right? So we will skip this point. Now another one is the trade credit. Third one is the FC bonds. Fourth one is the financial lease, and the last one is the share and debentures. Now what are these? Let's discuss them in details, right? Now starts with the shares. Basically the shares are of two types. One is the equity shares and the another one is the preference share. Basically equity shares are those shares which are used to raise capitals, or which are used to raise finance. So the company which is required finance, it will raise equity shares, or it can raise preference shares, it can raise another debt instrument, it can be a debentures. So there are multiple options. So So equity share, preference share and debentures, they are also one of the types of methods to raising finance. So equity share is basically one of the type of methods which is used by a company to raise finance, right? So wherein the investor, or we can say the holder of these such shares, gets the ownership in a company. Basically, the equity shares are what? The holder of these equity shares are the owner of the company up to that value of share which is acquired by those individuals, right? So income of these shareholder is what? It is the capital appreciation. So in simple, equity share is what? It is used to raise capital whenever the firm or a company requires capital. So it will raise equity shares, and the one who purchases those equity shares will gets the ownership in a company, in simple words, right? So one of the key point which we need to remember under ECB is that a one individual or a borrower, means the borrower or a Indian entity cannot avail ECB in the form of equity shares. So availing ECB in the form of equity share is not allowed. So you need to remember that point, right? Now let's move on to preference shares. So these are also used to raise capitals. Whenever a firm requires capital, it can raise those capital by issuing preference shares also. So right. So it is having preferential right, where means it can receive dividend prior to equity shareholders. Income of these shareholder is what? Regular dividend income. They cannot take part in a voting rights of a critical aspect of its company, right? So there are quite benefits and demerits of preference share also are there. So I will not get into deep of that, right? So if one need to avail ECB in the form of preference share, then it can avail in the form of two forms. One is the non-convertible preference share and another one is the partial convertible preference share. These only two forms of preference shares were allowed to raise ECB, and the rest type of preference share were not allowed under ECB to raise capital, right? So if a company needs to avail ECB in the form of preference share, then it has only two types of preference share under which it can avail ECB facility. The one is the non-convertible preference share and the another one is the partial convertible, or we can say optional convertible, right? So rest of the type of preference share were not allowed to raise capital under ECB. Let's move on to debenture. It is also one of the type to raise capital, right? It is basically a debt instrument which is not backed by any sort of collateral security or any sort of security. It is basically used by some big organizations, big firms, big companies. It can be a government organization also. So basically, a one can avail ECB in the form of issuing debentures. Here also, one can issue non-convertible debenture or a partial convertible debenture, and the rest type of debentures were not allowed to raise ECB. Now let's move forward. The trade credit. It is also one of the form of ECB, wherein one can avail ECB form in the form of buyer's credit also. It can also avail in the form of supplier's credit also. Now what is this buyer's credit and supplier's credit is what? Buyer's credit is basically a credit is extended to an importer, right? Means here the credit is extended to an importer. Against what? Against importing of goods into India. Now who is this extending this? It is extended by a bank, by a financial institution, right? So in simple words, if I want to say that what is buyer's credit is, then I can say that the buyer's credit is what? It is providing finance facility for making payment against import of goods or services to India. In simple words, buyer's credit. Whereas supplier's credit is somehow similar to buyer's credit, but there are few points that differentiate among them. Now, what are they? Basically, the type of transaction. It can be applied to any, whereas if we talk about the buyer's credit, it can be applied to any transaction, whether it is a collection bill or whether it is a LC bill or it is a direct import bill. Direct import is also called as open account payments, right? So it can be applied to any bills, whether it is document against acceptance, document against payment, usance, side bills. So it can be applied to any sort of bills. Means buyer's credit can be applied to any type of transaction. But a supplier credit can only be applied to a transaction which is backed by a letter of credit. So you need to remember that. There are few points. So what are those points? I am just listing here. Now second one is the who applies for, means buyer's credit is applied by a importer, whereas the supplier credit is applied by whom? It is applied by a supplier, right? So these were the few points. One more point is also there, that a buyer's credit can be rollover, but a supplier's credit cannot be rollover. So basically, buyer's credit and supplier's credit was somehow similar, but their features makes difference in them. Right? Now let's move forward. Now we will talk about the FC bonds. Now FC stands for foreign currency bonds. Means those bonds which are issued in a foreign currency. It can be a dollar, it can be a euro, it can be a GBP, it can be any other foreign currency. Right? So basically, one can raise ECB in the form of foreign currency bond also. So these type of bonds were FCEB and FCCB. Now what is these bonds are? Basically, FCEB bonds are foreign currency exchangeable bonds, right? Whereas FCCB are foreign currency convertible bonds. Now what are these bonds are? In simple words, foreign currency exchangeable bonds are those bonds. It is basically the type of those bonds which can be converted into, or sorry, which can be exchanged with another bonds of another company. Means these foreign currency exchangeable bonds are basically those bonds which are in foreign currency and that can be exchanged with bonds of another company. That another company is called offer company, or the company which is, and the issuing company is the company which is issuing such bonds, and the offered company is the that company in whose the those bonds will be exchanged, right? Whereas foreign currency convertible bonds are basically those bonds which are converted into equity shares on a maturity date. So there is a quite difference. Means in FCCB, in these bonds will be convertible into equity shares on the maturity date. Whereas under in these are those bonds which can be exchangeable into the bonds of another company. That another company will be called as offered company. Means here the issuing company and the offered company will be the different company. But here the issuing company and the offered company will be the same. Now let's move forward. Now we will talk about the financial lease. Financial lease, it can also be called as capital lease. It can also be called as sales lease. So there were multiple names of it, right? So basically, there are two parties were there. One is the lessor and the second one is the lessee, right? So basically there would be an agreement between both the parties, right? So what is that agreement is? Before understanding that agreement, we will understand whom these parties are. The lessor would be the legal owner of that goods or machine, whatever it is, which is providing such finance, or we can say that it is a finance company which is providing finance facility. Whereas the lessee is the borrower, which is borrowing such loan. And also we can call it as operative control, means though the lessor would be the legal owner of that machinery, but the operative control will be in the hand of lessee. So you need to remember that, right? So the lessor would transfer that ownership of assets. Asset here means the, it can be a machinery, it can be anything, right? So here the lessor would transfer that ownership of that asset to the lessee. Now when it will transfer? Post that lease period is over as per the agreement, right? So once the lease period is over, then the lessor will transfer that ownership of that asset to the lessee, and the lessee will pay the rent or installment as per the agreement. So under this, the borrower, or we can say that the customer, means the lessee, will use that asset during the lease, right? Or after that it will pay those rent or installment to the lessor according to the agreement. So the lessee is having the right or the option to choose to acquire that ownership of that assets, or in simple word, the lessee will be allowed the choice of buying that asset at a bargaining price, or we can say at a discounted price if we compare it with the market price, right? So this is all about the video. The next part will be the part of 2 of external commercial borrowing. So it will be uploaded soon. Thanks for watching.